What if saving America meant butchering its economy first? October 1979. The United States was hemorrhaging to death in slow motion. The stagflation trigger we exposed in our last file had spawned a beast. The dollar was disintegrating. Inflation was devouring paychecks like a flesh-eating disease. The American dream was flatlining on the operating table. Washington had thrown everything at the problem, except the one solution that would actually work, the one thing that terrified them too much to even whisper about. Saturday night, October 6, 1979. Rain hammered the dark streets of Washington, D.C. Most of the city slept, oblivious. But deep inside the limestone fortress of the Federal Reserve, every light blazed. A secret meeting had been convened. At the head of the table sat a man who looked less like a central banker and more like something carved from granite. Paul Volcker. 6'7" of rumpled suit and raw intimidation, chain-smoking cheap cigars that filled the room with acrid smoke. His voice was a low growl, almost a mumble, but his eyes were tempered steel, cold, calculating, and absolutely merciless. He surveyed the room. His colleagues, the men who controlled the monetary lifeblood of the United States, stared back with barely concealed terror. They understood what Volcker was about to propose was nothing less than deliberate economic carnage. He delivered the unvarnished truth. To execute the ghost of inflation, they would need to take a sledgehammer to the American economy. They would need to engineer the most savage recession since the Great Depression, intentionally. That night entered history as the Saturday Night Special, and it demonstrated a brutal principle. Sometimes the cure is more vicious than the disease itself. This is File 55.5, The Ghost of Inflation. In our last file, we documented the crime, how political cowardice shattered the dollar in the 1960s. Today, we witness the punishment. This is the story of the lost decade, the gas lines that stretched into nightmares, and the giant lurking in the shadows who became the most despised man in America in order to save it. To understand why Paul Volcker had to become so ruthlessly destructive, you need to grasp the nature of the monster stalking him. By 1979, inflation wasn't an abstract economic indicator. It was a malevolent presence that invaded every home in America. It was psychological warfare waged against an entire population. Picture this: you cash your paycheck on Friday afternoon. You don't celebrate. You don't relax. You sprint to the grocery store, heart pounding, because you know with sick certainty that the milk and bread will cost more by Monday morning, maybe significantly more. Savings became a sick joke. Putting money in the bank was functionally identical to lighting it on fire, watching it burn, because inflation devoured its value faster than interest could possibly compensate. The American dream was running in reverse, like a film played backward. Hard work didn't propel you forward. It barely kept you treading water. Debt became the only survival strategy. Then there were the visible wounds scarred across the nation, the gas lines of the 1970s. We've all seen the archival footage, but few truly remember the visceral dread. Miles upon miles of cars choking every highway, fathers brawling with fistfuls of crumpled cash just to purchase 5 gallons of fuel. Violence over petroleum. The misery index, unemployment rate plus inflation rate, reached levels not seen since the Great Depression. President Jimmy Carter appeared on television screens across the nation and delivered his infamous diagnosis, a crisis of confidence. He called it malaise, trying to psychologize away an economic catastrophe. But the American people weren't fooled. This wasn't a collective mood disorder. This was systemic failure. The machinery of American capitalism was seizing up, gears grinding, belching smoke. The ghost of the 1965 guns and butter decision had finally come to collect its blood debt. Washington had attempted to fight the ghost before Volcker. but they'd brought water pistols to an inferno. President Gerald Ford launched a PR campaign so painfully naive, it became a punchline. He ordered the printing of millions of red buttons emblazoned with "Win, whip inflation now." He urged Americans to plant vegetable gardens and carpool to work. Economic self-help advice to combat a systemic monetary crisis. The ghost laughed in his face. Inflation accelerated. President Carter tried moral lecturing. He scolded the public about greed and excess. He attempted to impose wage and price controls. The Federal Reserve, the one institution with actual power to strangle the beast, was paralyzed by its own cowardice. They remained haunted by the memory of the ranch meeting we dissected in File 55.4. They lived in mortal terror that if they raised interest rates too aggressively, the president would destroy them politically, or Congress would strip away their independence. So they committed the worst possible sin. They hesitated. They'd nudge rates up tentatively, panic when the economy flinched, then immediately lower them again. This pathetic stop-go policy only fed the monster. It trained the markets that the Fed was weak, that it would always blink first. By summer 1979, the dollar was in complete freefall. Foreign governments were dumping U.S. currency like radioactive waste. The entire global financial architecture was buckling toward systemic collapse. The White House had exhausted every option. They couldn't deploy another politician. They couldn't send a diplomat with soft words and softer solutions. Enter Paul Volcker. The story of his appointment stands as one of the great presidential ironies. Jimmy Carter, desperate to stabilize the markets before his re-election campaign imploded, summoned Volcker to the Oval Office for what was effectively a job interview. Volcker didn't perform. He didn't reassure. He didn't offer comfortable lies. He sat there, this towering, disheveled figure wreathed in cigar smoke, utterly indifferent to polls or political considerations, and delivered unvarnished brutality. His message was reportedly stark. "Mr. President, if you appoint me, I will operate independently. I will strangle the money supply and the economy will bleed." He was telling Jimmy Carter in no uncertain terms, "If you give me this job, I'm going to inflict pain, severe pain, and it will almost certainly destroy your presidency." Carter, cornered by circumstances and running out of time, appointed him anyway. He convinced himself he could manage the giant. He believed Volcker would be pragmatic, reasonable, controllable. He catastrophically misjudged his man. August 6, 1979. Paul Volcker was sworn in as chairman of the Federal Reserve. He didn't smile for the cameras. He didn't give inspirational speeches. He went immediately to work, understanding with absolute clarity that the only method to execute the ghost was starvation. Inflation is created by too much money hunting too few goods. Volcker decided he would shut off the monetary spigot, not gradually reduce the flow. He was going to weld the valve shut with a blowtorch. Which brings us back to that rain-soaked Saturday night in October, and the moment Volcker decided to poison the patient in order to save him. The Saturday night special wasn't merely an interest rate adjustment, it was a regime change. Volcker announced that the Federal Reserve would abandon any pretense of gently managing interest rates. Instead, they would directly target the money supply itself. They would impose brutal limits on the volume of dollars permitted to circulate through the banking system. When the supply of money suddenly evaporated, the price of money, interest rates, detonated. 1980, the prime rate hit 20%. Then it climbed to 21.5%. Absorb that for a moment. Imagine attempting to purchase a house today with a 15% mortgage rate. Imagine operating a small business when a loan to purchase inventory carries over 20% interest. Construction sites went silent as graveyards. Car dealerships transformed into acres of unsold metal, rusting monuments to frozen commerce. Volcker knew this devastation was inevitable. He understood that to obliterate the inflation psychology gripping the nation, He had to shatter the economy's spine. By 1981, Paul Volcker had become the most hated man in the Western Hemisphere. The American public didn't recognize him as a savior performing necessary surgery. They saw him as a sadistic destroyer obliterating their livelihoods for abstract economic theories. Farmers, dependent on loans to purchase seeds and equipment for every planting season, were systematically annihilated. In scenes that could have been lifted from revolutionary France, thousands of enraged farmers drove their massive tractors directly to Washington, D.C. They encircled the Federal Reserve building, blockading streets with tons of agricultural machinery, demanding Volcker's immediate resignation. Construction workers, thrown into unemployment by the thousands, mailed him 2x4s of lumber with profane, desperate messages scrawled across them. But the most chilling protest materialized from the automobile dealers. Across the country, dealerships were collapsing into bankruptcy because potential customers couldn't possibly afford car loans at 18%, 20% interest. Desperate and consumed by rage, dealers began mailing envelopes to the Federal Reserve. When Volcker's staff opened them, they found keys, car keys, hundreds of them. "You are executing us. Here are the keys to businesses you've murdered." Politicians from both parties bayed for his blood. They demanded that the new president, Ronald Reagan, fire him immediately. They characterized Volcker as a rogue economic assassin, an unelected dictator systematically destroying the American dream while hiding behind bureaucratic independence. But deep inside the Fed, Volcker sat in his smoke-filled office, surrounded by clouds of cheap cigar exhaust, and refused to move a single inch. The war reached its climax in 1982. The economy wasn't merely contracting, it was dying in real time. Unemployment exploded to 10.8%, the highest recorded rate since the Great Depression. Companies that had survived for half a century were shuttering permanently. Then the international banking crisis metastasized. Developing nations like Mexico, which had gorged themselves on billions in cheap dollar-denominated debt, suddenly couldn't service the interest payments on their new, ruinously expensive obligations. They would have fired up the printing presses, flooded the system with liquidity to rescue the banks and arrest unemployment. The pressure crushing down on Volcker was beyond imagination. He was receiving credible death threats. He required Secret Service protection just to walk to his car. But Volcker examined the data with his cold, analytical eye, surveying the wreckage spread before him, and he detected something invisible to everyone else. Inflation, which had peaked near 15%, was plummeting like a stone dropped from a cliff. 10%, then 8%, then 5%. The fever gripping the nation was finally breaking. Volcker recognized that the market psychology had fundamentally shifted. People no longer assumed prices would climb forever. They'd finally internalized that this towering giant was insane enough, committed enough to maintain crushing interest rates for years if necessary. Trust in the dollar was cautiously, tentatively returning. He had won the war, but the battlefield resembled a graveyard, littered with the corpses of businesses and the broken dreams of an entire generation. By 1983, the storm had finally passed overhead. As inflation vanished like a dispelled curse, the economy began its resurrection. With the dollar stable for the first time in 15 years, businesses tentatively began investing again. Capital started flowing. The stock market launched into the massive Reagan boom that would sustain itself for nearly 2 decades. Paul Volcker stepped down in 1987. He departed not with parades or medals, but with quiet, grudging respect. The man who had been sent car keys and death threats was now being reluctantly acknowledged as the brutal savior who'd done what no one else had the spine to attempt. He had demonstrated an uncomfortable truth. The only path to long-term economic health is sound money. But the critical lesson of File 55.5 isn't about economic history. It's a warning about what's coming. The ghost of inflation is never truly destroyed. It only sleeps, waiting. Today, right now, as you watch this, we're witnessing the same patterns metastasizing that we observed in the 1960s. Massive, uncontrolled government spending, guns and butter all over again. We've forgotten the agony of the 1970s. We've forgotten the car keys mailed in rage. Paul Volcker died in 2019. The giant who was willing to be hated is gone. And the terrifying question we must confront is brutally simple. When the ghost returns, and it will return as inevitably as sunrise, do we have anyone left with the courage to fight it? Or have we become so addicted to easy money, so dependent on the constant flow of cheap credit that we can no longer survive the cure? The files are open. The truth has been declassified. This is history declassified.